Good morning, everyone. Hope you're all doing well. It is Wednesday. What is it? Wednesday, September 11th. So we had the CPI data here pre-market today that was creating headlines. A lot of people mainly waiting for this throughout the last few days here as the week shapes up. We've also got the quad which is coming out next week, where we're going to see that rollover in contracts, right? The expirations coming out for options and futures, the quarterly expiration, which is a big deal, and then also next week we have the FOMC, the first expected rate cut that we've got cooking 2020. So big things ahead now. The main topic of conversation, the U.S. Consumer Price Index, the inflation data that was published this morning about 30 minutes ago. Well, the Fed usually turns to the PCE price index. That's their general favorite inflation gauge to monitor price pressures. Today's report is going to be the last inflation print that we see before the FOMC next week, so that rate decision. So investors are primed for another soft reading, right? Everyone was expecting kind of a softer touch as inflation continues to cool, realistically helping with a decline in gasoline prices during the month and a labor market that has been cooling as well. The headline CPI is expected to come in at 2.5%, which could mark the first inflation fell firmly below the 3% mark in over 3 years. And it would also mean that inflation is a close to 2 to 3% target that is pretty much the Fed's target overall. So we'll see what these look like, right? There are two broad categories that are still above the 5% annual inflation. Let me just get rid of one of these. 2% above the, there's two broad categories still above the 5% annual inflation. Shelter is at 5.1% and transportation at 8.8%. Insurance and maintenance repair. This is what one of the analysts wrote about this. So the return to price stability requires a stabilization in shelter inflation, given its weight in the CPI. In fact, the key argument for the expected return to price stability is in the expected fall in rents. So the Fed policymakers have made it clear that it is time indeed to cut rates. However, the biggest debate on Wall Street is by how much. Currently, if we take a look at this, one of our favorite sites here, we have an 85% chance that we are going to see just 25 bips, right? One singular cut. Just a week ago, the skew was pretty 50-50 in terms of seeing either a double cut or one cut. The double cut would come in as a big surprise, and I don't think the markets are going to take too kindly to that. So the CPI figures that came out today, here we can look at them on Financial Juice, right? This is a free site that you guys can take a gander at. No affiliation with them, but I like the information that they present, so why not promote what they've got cooking? So I don't know if you can see it fully, but you can see here the Supercore CPI data. I'm looking at these data figures over here. So US CPI year over year, 2.5%. As expected, it comes out. The prior was 2.5, so pretty big advance from there. The US month over month, 0.2%. As expected, as prior. The U.S. core 3.2%, as expected, as prior. And then the U.S. core CPI month over month, just a little slight uptick by 0.1% versus the 0.2% expected. So these figures, they came out in line with expectation. Generally, a little bit of a decline from the prior pricing, which is good realistically. The first movement that we saw in these markets was a pull to the downside before a massive plethora of buy side came out on the S&P and on the NASDAQ towards these levels that look like pretty good longs. So we've been looking at the same level all in all over the past few days, right around that 70. But the initial reaction from the market was a little bit skewed to the downside there, while... What am I doing here? So the first initial move was skewed a little to the downside, but we're trying to get that push to the upside right now. Markets are swinging back higher. So we'll see. We have PPI tomorrow morning too, but it's going to be less of a mover in comparison to what's going on with the CPI here today. Came out first. So last night we also had the U.S. presidential debate between Kamala Harris and Donald Trump. So they're... I didn't watch it. It was super late for me. I didn't really know what happened, so I can't really talk about it. But it kind of moved markets a little. Not expecting too much. So we're going to see how that kind of shapes up in the coming months, realistically, as we get closer and closer to the election. But we're still trying to continue some of that upside press. I don't have any information about this debate, nor did I look at it. It's not necessarily in my realm of understanding, not a political figure here. So it's good to understand, though. It's good to note that it did happen. So another aspect in these markets, right? One of the big things that happened yesterday that I can talk a little more about was financials. So financials took a pretty big slip, right? JP Morgan had a big tumble, Citi, all of the all the big banks, all the general financials took a nice little beating. JP Morgan was down about 6% at one point in a single day. Goldman Sachs was a bit lower. Citigroup as well, down about a decent chunk here if it wants to load. Citigroup was down about like 2.5, 3%, right? We had Wells Fargo. Wells Fargo dropped down as well. Not a crazy amount, but from the spike that it had a pretty decent move to the downside. So um, the largest lenders will only face a 9% hike in capital requirements under the revised Basel III Endgame proposal unveiled yesterday, which was well below the 19% increase floated around in the original plan. We saw that Fed Vice Chair for Supervision Michael Barr said in an update said the updated deal would bring the benefits and cost of the hike into a better balance. Shares of not too big banks still fell, like pretty much all banks fell, by JP Morgan after President Daniel Pinto warned that the earnings expectations were too high. Ally Financial also plunged about 18% after flagging the worst credit conditions among the borrowers. So yesterday there was a lot of news around these banks, right? If we hover over this, we can see what the news was on TradingView. It's pretty good, right? You can see over here some key facts. Piper Sandler lowered its price target on Wells Fargo to $60, and Goldman Sachs cut its target to 65. Analysts have an average outperform rating with price targets from 57 to $70, right? It increased by 2.8% in the pre-market trading as bank stocks rose following a report that suggested an increase in regulators' capital requirements will be less than expected, what we talked about, and then things kind of hit the fan. So I think that like here, if you hover over the JP Morgan one, right, you can see some of the information as well. So a lot of that concerns were highlighted in the financial sector, especially around these rate cuts, was a big news event yesterday. But I think these guys are oversold. I think financials in general got a little overreacted from that downside move. Like Bank of America, I believe, was down not so much, but like JP Morgan and Goldman Sachs fell a decent bit. So I think it was more of an overreaction where we could start seeing the potential turning point in these in the coming days, especially if the equity market starts to continues the rally that we've been seeing. So in terms of news, that's mainly what we got going on. We have quarterly services survey at 10 a.m. today, and then EIA petroleum status report at 10:30. Not too much, as we've moved over the hump of the CPI. Tomorrow's the PPI, and then everyone's rubbing their hands together in anticipation of the Fed next week, the Fed and Quadwitch next week. So two pretty big events, and we'll see how things shape up until then. But I'm still looking for the bull side momentum, and I'll explain why in these markets. It's just a factor of getting an expansion. So we've moved into this like balanced auction to the upside over the last few days, and we're holding the support structure from it. Right, we're trading 54.65 to 70. They're still containing that bull side momentum, trying to get that push from those areas to squeeze up a little to the upside. But a very key factor, we have a lot of volume that's accumulated into these highs, as well as we got a lot of positive delta into these highs. So all this positive delta, all this volume accumulating is still stalling prices out from getting that acceptance higher. For me, the real bull, 55.05.10. If we can get that expansion, I think buying dips makes the most sense in this market going forward for today, right? Maybe even into the end of the week. But as long as we can hold 54.65 area, I think that those buyers are still pretty happy about this, but we need to desperately make a new high. That's what I'm looking for today. So with that being said, let's open up our room today, and I'll see you guys in there. We'll stream on Friday. I'll see you guys for a more extended session on Friday. And let's wrap it up from there. So enjoy the day, enjoy the trading, and we'll chat very soon.